Good afternoon, everybody. I'm Richard McMahon. I'm Senior Vice President of Energy Supply and Finance at EEI, and you are in the Future of ESG Reporting. And I know it's an exciting topic because we just filed our comments at SEC, and I just checked today, and there are over 6,000 sets of comments filed on this issue. So hugely, hugely important. I think our industry, as you know, has been a leader on ESG reporting. We put in place a template more than 6 years ago, really setting the standard. We helped a lot of other industry groups set their ESG reporting, but clearly, given the response to the SEC's notice, there are a lot of things that probably need to change, we hope, in the final rule. But we've assembled a fantastic panel for you today, and I'll just walk through everybody's names. Their bios are in your materials. To my immediate left, Barbara Chapman, Senior Director of Fitch Ratings. John Colella, Managing Director, Moelis Company. Dan Hahn, Partner, Energy, Sustainability, and Infrastructure at Guidehouse. Rebecca Kujawa, President and CEO, NextEra Energy Resources. So we're really going to try to make this conversational up here. We'll kind of act like we're all sitting around having a cup of coffee and discussing these topics. At least that's our goal. So, but before we go, I'm going to start and just ask everybody on the panel to just give a minute or two, kind of their point of view on this issue and a little bit of an introduction.
Sure. I'll start. I'm Barbara Chapman, Senior Director of Fitch Ratings. I'm a rating analyst. I cover companies. ESG has been something, it has a name on it now, but it's really always been in the industry. And now, the reporting template, that certainly has moved us along. But if you think about it, when the Clean Air Act was passed and all the amendments since has really put the industry under a microscope as far as environmental issues, and maybe the S&G is a little bit more recent, but it's something that has been there. It has a name on it, and it's going to continue in maybe different formats, different focus as we go through, and maybe more delineated as we have with the SEC things than what we've had in the past.
John.
Great, thanks. Richard, John Colella, I'm a managing director at Moelis Company, so I'm an investment banker, and in my role really focus on strategy, M&A, capital markets, and obviously ESG has very much been at the center of all of that over the last several years. A few perspectives, over the course of really the last couple of years, the question I think that we've dealt with really more than anything else has been sort of what has really been the role of ESG at the center of capital flows. And in this industry, it's been a really tough question to answer. First, because as Richard said, this industry really has been at the forefront of ESG disclosure and practices, et cetera, relative to just about any other industry. And so a lot of the practices that are embedded within E, S, and G were really behaviors that were largely already in place. And so then it leads to this kind of question of, did the branding around ESG, as Barbara put it, did that really change anything? Well, I'm sure we'll have an interesting discussion around that. Also have to recognize that when you think about the impact of ESG, we've kind of come at this from the perspective the last sort of decade or so of an environment where capital has largely been abundant and cheap. And so that has made it increasingly difficult for investors to really differentiate. In a market where all assets were well valued, there's some interesting question around how do you differentiate between different assets. And ESG, I would posit, has become one of those differentiating metrics. As we look into the future, though, I think there's an interesting question around if we are transitioning into an environment where capital is less abundant and more expensive, will ESG continue to play the same role, or will other factors such as profitability, supply chain, commodity prices, et cetera, will that overtake the impact or the role or importance of ESG? So looking forward to the discussion. Thanks, Richard.
Sure. Dan.
Good afternoon, everyone. My name is Dan Hahn. I'm with Guidehouse, and I'm a partner there and I lead our energy providers practice. In addition, I'm an adjunct professor at Northwestern's Institute of Energy and Sustainability. The ESG topic is well known. When we think about ESG for myself and our team and our clients, ESG has been around in practice for quite some time. And with the formality of what it's done now, and if you really think about it, it's table stakes to how any investor, any corporation, any community thinks about themselves in regards to the value that they add, not only to the immediate customers they serve, but also to the broader community set. And I think that's why in this industry, especially the utility industry, has been such a primary player in that, and it's been a very strong presence. The challenges that we see coming with regards to ESG reporting is clear with regards to standardization, definition of understanding, and to what level of requirements are really going to be needed is something that is becoming much more of the talk these days with the leaders that are out there. And I look forward to having a conversation with you all about this, and appreciate the invitation.
Thanks, Dan. Rebecca?
Yeah, thank you, Richard. And hopefully, can you guys hear me?
Yeah.
Mic back on now? I can definitely project, but I don't know if that's
Good. We can hear
You
you.
guys might get shocked if I actually
hear
get
you.
turned on at some point. Well, we'll go with it. So I'm Rebecca Kujawa from NextEra Energy and officially CEO of NextEra Energy Resources. And I'm really proud to say that ESG, I think, at the end of the day, is really just good business. It's something that we've been on a path really on for the last 30 years. Of course, focused on environmental responsibility, building a lot of renewables, finding ways to be more clean and more sustainable in our business, but also focusing on employees and focusing on diversity of thought, ensuring from a governance standpoint that you make good decisions. I have interesting engagements with the finance community throughout my career and saw a real focus on ESG more than a decade ago, probably closer to 2 decades ago in European investors, where it was already a primary focus of where they're going to allocate capital. And it really wasn't until, I would say, the last 5 years that it really became as prominent as it is now and on the track that it is here in the U.S. But I think it's deeply rooted. I don't think it changes. I think definitionally it's really important for us to embrace the fact that it can mean different things to different people. And as you start translating that to regulatory requirements and reporting requirements, then we need to think about what does it mean. Again, at the heart of it, really, really good business. I'll talk a little quieter now. At the heart of it, really good business, but we need to think more about what that means from a reporting standpoint.
That's such a good point. And one of the things that before we came up here, we were just sort of chatting about ESG generally. It's such an evolving concept. It seems to be, when we started six plus years ago, all our investors wanted to talk about when we gathered them was E, capital E, little lowercase s, lowercase g. And as our panelists said, I think we as an industry, have a very strong story to tell across the ESG spectrum. At the same time, SEC is already actually starting to take some enforcement actions against funds for greenwashing under this definition of ESG. But it's difficult because there really isn't a definition. It is evolving. So I guess let me ask the panel, we started with a big focus on environment, but in your interactions from your different disciplines, are you seeing that evolve, or are the big investors interested in something other than the E from us? And so I'll just open it up. Who would like to chime in first? We'll kind of make it conversational if we can.
So I know social is something that's been near and dear, especially over the last couple of years of what's transpired. So diversity, and now we're going to have socially linked bonds where we just had environmentally linked bonds. That's something that we're seeing much more of.
Look, I think from a branding perspective, what ESG has done has kind of created an environment over the last sort of 5 years or so, at least here in the U.S., where disclosure has become more abundant, more organized. I think you can look at any company's investor decks, and you know where to look for kind of all the S and the G disclosures to be presented in a sort of organized format. And so that has had some incremental value. However, when we talk to and interact with investors, whether it's public market investors or private market investors, the question around how they utilize that information and to what degree they utilize it to actually make marginal investing decisions is just very unclear at this stage. And I think the reason it's unclear is not because all of those initiatives on S&G aren't important and they aren't things to be proud of as an industry. I think it's because in many respects, again, I'll go back to, these are behaviors, good governance practices, good social and community employee engagement. These are all things that this industry's been doing. You wouldn't be in business if you weren't doing that already, and you wouldn't be attracting capital if you weren't doing it well. So again, I think that as it relates to kind of the branding around ESG, I sort of separate that a little bit from the actual practices. I think the practices are important. They're here to stay. They were always here to begin with. That's not new. The real question is what will the role of the scoring and a lot of the sort of reporting that has developed around ESG, how will that manifest in terms of capital allocation on the margin over time?
Just related to that, if you have strong ESG, are there alpha returns to be generated there or more access to capital? What are people saying?
So it's interesting. I was just looking at the data earlier today and be interested to get views from others on the panel and in the audience. But we've tried really hard to look for data that suggests that ESG orientation, ESG specific funds have actually outperformed the market. And granted, the window, at least here in the US, is a relatively short one because ESG as a brand is a relatively new phenomenon in the grander scheme. But if you look last year, I think it was the iShares ETF, the MSCI, et cetera, so one of the largest ESG funds, returned the exact same return as the S&P 500. And by the way, that makes sense because, you know, the real question is, what is an ESG fund? Everyone loves ESG. I'm pretty sure we can agree on that. Everyone wants to be ESG oriented, right?
I think that's being put to the test right now, actually.
Actually, Richard, interestingly, if you look at what's happened 2022 year to date, the ESG, a lot of the ESG funds are actually underperforming the broader market. Why? Because they're underinvested in oil and gas, which I think is an interesting discussion around how ESG investing has impacted capital flows around a series of commodities that are very near and dear to our hearts in this industry.
Yeah, I would say I was previously CFO just a couple of months ago, and so I spent a lot of time with investors talking about this very subject and saw the evolution, even as I mentioned, in the recent couple of years. I remember at the beginning of my tenure as CFO, which is about 2019, I started asking investors, like, how much of your capital base, so not the fund, company that was investing in us, but the source of capital for them, how much of it is ESG oriented? And it increased over time, but I would say recently, and probably through the course of end of 2020 into 2021, it was immediately all of it. There isn't a single investor that isn't focused on ESG or asking us about what's important to us with respect to ESG. I would say from a capital markets perspective, we also started to see a differentiation in just being able to raise capital. I pushed everybody to try to quantify it, and we ultimately agree that it's probably 5 to 10 basis points of differentiation when you think about going out for debt capital. Now we're planning to invest $85 to $95 billion over the next 4 years, so I care about every basis point. But it's still small, right? And for us, we were making the effort of ensuring that the dollars that we raised were directly invested in specific projects and ensuring that we felt good and they felt good about what those attributes mean. But I think it's changed a lot over time. I would say for our industry, I think everyone would expect, and I think it's true, most of the focus is on the environmental side. Questions will be asked about social and governance. Are we good companies? Are we focused on the right things? But I think as long as we have a good story to tell with that, and a lot of that can even be measured with data, the focus comes back to environmental, and people want to see real, tangible, tactical, and strategic goals for us as companies in the industry.
Yeah, and to just piggyback on what Rebecca mentioned, as her, during her tenure being a CFO, we had a chance to actually perform an ESG assessment and really take a look at how do the ESG funds view NextEra, how are the rating agencies looking at them, and is NextEra Energy represented in a fairly, from a percentage of portfolio holdings. And it's really interesting that, NextEra is a leading utility energy company that we all know, and they walk the talk. And coming out of that assessment, we came up with some recommendations to help them look at other parts of the acronym, things around S&G specifically with regards to human capital. And that human capital could be within the four walls of the organization, as well as the community impacts that you make as well. And so when we look at S and then segueing into the S and the G part, I did this lookup around, 5 years ago, what percentage of investor calls included the ESG? It was like maybe 6 or 7%, right? In today's world, regardless of what industry you're in, what sector you're in, ESG is almost 80% of every investor call. And so if you think about the industry we're in, and I think about products and services that you as utilities provide to your customers, primarily C&I customers, how can you play a role in helping their ESG footprint as well is really an opportunity for this industry.
And maybe it's kind of the opposite, where it's not just that you're telling a good story with ESG and you're walking the walk, as you said, but also if you don't, then you're doing it at your own peril, right? If you don't have an ESG story, or if you're ignoring it, it's just not going to work. And obviously, this industry is on the forefront. So, Barbara, let me just turn to you on the point of, from a rating agency perspective. I know a lot of the rating agencies are starting to wade into the space. There's been sort of acquisitions of ESG firms, the sort of standalone firms to bring into the rating agencies. Are you, and from what I've seen of the rating agencies look at ESG, it's more sort of a qualitative assessment. Is this actually going to get into the quantitative metrics, the credit metrics that are used on companies, ours and others? Where do you see it going?
Yeah. Well, first, let me make a distinction for anybody in the room that may not know this. There's rating agencies and then there's credit rating agencies. So Fitch Ratings is a credit rating agency, and our task is to put a measurement of risk of default. Now, there's also things like MSCI and many of those type of entities which are called rating agencies. They are not credit rating. They are not regulated. The credit rating agencies are very heavily regulated. So that being said, we all have other products. So there's something, Sustainable Fitch, which is a sister company to what we do. And they do have a suite of products that they can put an assessment score on a bond, they can put it on a company. They have various things, but that is different than what we do. Now, we have what we call a relevant score, but really what this relevant score is just putting a name on something we were already doing. Again, we measure risk of default. We care about cash flow, we care about debt balances. And so if, what you're doing, the classic case is you have coal ash. Coal ash is fine as long as your regulators allow you to recover it. Now, if that pond leaks, then you have a problem. And so, a lot of our scoring was around things that, so it's a qualitative and a quantitative. And the two things we care about in assessing cash flow and debt is accessibility of capital and your regulatory relationships. So if you do something that's a problem for a regulatory relationship, and in some ways we're very worried now about the social aspects, because we've heard a couple times today, bills and equity. And that's something, if you annoy your regulators and you're in a world of hurt, and we actually did have an ESG score for social on a company that put in a new rate in the middle of summer and messaged it very badly. And it ended up being terrible for the company and causing all sorts of regulatory stuff. So it's a qualitative aspect, it filters into the quantitative aspect.
So there can be a level of materiality, financial
Yes,
materiality.
and it has to be materiality. We had a company that had an issue that qualified for a governance problem, but they had a legislatively mandated rate plan that couldn't be altered. So yeah, it's not good, it's a worry, but it wasn't there wasn't anything that could happen to their rates for, till they go in for a rate case, and that hasn't happened yet. So it has to have, for us, it has to be materiality, it has to be something actionable, not just you think they were bad in this area. You got a point to say, and you go into a rating committee, they're like, well, what is the risk? Where's the financial impact of that?
Mm-hmm. Well, since we're talking about materiality and something significant, I want to turn to you, Rebecca, now. NextEra just made an announcement less than a week ago that basically on a zero emission, not net zero climate goal by 2045, could you explain kind of how that announcement is groundbreaking, really, and how you're going to get it done?
Yep, we're thrilled to be in the position to make the announcement. I think you got it, exactly right. Our ambition is to achieve real zero by 2045. That really is really super exciting to us, and something that we've waited for a long time to be able to announce, because we want it to be credible, we wanted to have a plan for how we can achieve it, and we wanted to be able to lay that out for our stakeholders. And it's critically founded on a number of things, including that we're able to do it at no incremental cost to customers, that there's continuing technological advancements, of course, supportive regulatory policies, and ultimately are making investments that our regulators can approve. But as we lay out what that plan looks like, we can see it coming together. And in Florida, which is where most of the opportunity is for us to work towards achieving real zero, it's through the opportunity to deploy a significant amount of solar energy, battery storage, and ultimately convert some of our natural gas plants to run on hydrogen longer term. It's huge incremental investment opportunity. We also worked with a world-wide leader consulting company to assess what the impacts are. And one of the exciting things that we saw, just for the Florida decarbonization opportunity, it's about a $15 billion annual increase to GDP in Florida from making these types of investments. And obviously, I'm very focused, of course, on Florida. I'm so glad you all are here. Continue to consume as much power as you possibly can. We certainly appreciate it. But I also am focused outside of Florida and what the opportunity presents. And if you think about the broad decarbonization, not just of the power sector, but broader parts of the US economy, we again worked with a consulting company to assess the economic impacts, and that's $2 trillion of incremental annual GDP. Now, I lack some context for what $1 trillion actually looks like. So we also strive to put that in context. If you think about annual GDP growth across the entire US economy of being about 2 to 3 percentage points, this is an incremental 25 to 30 basis points. So roughly 10% incremental growth annually in GDP. Like, that's going back to, it's good business. It's good for the environment, it's good for the economy, good for our customers. Something we're really excited to announce and are really excited to start making progress towards.
Yeah, that's really incredible. And going back to the SEC rule just a little bit, one of the sort of concerns that we had with the rule as it was proposed, that it kind of went, and the companies that have stepped out and put goals in place and really kind of put it out there, like NextEra and most of our members have done, the rule is a little bit more stringent on those companies than it is on those that haven't. And so we're really hoping when the rule evolves and the input that we gave to SEC last Friday, that they'll really take it to heart and the rule will evolve, because really, the goal should be to get more and more companies doing things like that and putting their goals out there and moving toward those goals. So that's really one of the things we're focused on.
And it's critical to have the plan, exactly to your point. We don't know what shape the SEC regulations are going to take, but whether it's those stakeholders, our investors, our community stakeholders, our political stakeholders, you need to have a plan for how you're going to achieve it.
Absolutely. John, let me turn to you. You had alluded to a little bit the sort of tumult that you're seeing, and obviously that we're seeing in the economy with inflation at 40-year record highs, interest rates rising. Where do you see the kind of the role of ESG in the capital markets evolving? Do you see, sort of winners and losers shaping out there? Will it continue to be a very critical, important consideration for investors? I know a lot of, obviously, the institutions are. But, are they going to be put under pressure, like you said, where, do they participate in the run-up of certain commodities that may not be friendly to ESG, that sort of thing? How's that going to play out? How do you see it playing out?
Yeah, so look, I think with the evolution of the market, naturally there's going to be an evolution in how we define ESG, how we value ESG on a relative basis, et cetera. Rebecca, to your point, a lot of what really ESG is just good business. Good business is always going to be rewarded. NextEra, I would posit, you're setting your internal goals because you believe you will make money doing that, as opposed to because of the ESG score in and of itself. They're interrelated, but first and foremost, right, it's all about making money. Same thing is with S and G. If you don't have good social practices, you're not going to attract employees. You're not going to, and governance, et cetera. You're not going to be able to attract capital. So I think the premium over the next decade or so in a more scarce capital environment is going to be on making money, being profitable, And it's going to be hard to do those things without having good business practices in place. Just like in this industry, if you don't have good safety measures, you're probably not going to, be the most profitable utility company. And so the way I would characterize it, and the analogy I like to use, Richard, is the development of the ESG kind of framework is a little bit like the development of safety features on cars, right? There was a time when people like me bought Volvos because they had the best seat belts or the best safety features. I still buy Volvos. I like Volvos, but
I never bought a car for the seat belts, but
but if you go, fair enough. But if you go back far enough, I'm sure there was a time when that in and of itself was a distinguishing feature.
They weren't always made.
But the point is that today, all cars have probably great safety features, and there's been a convergence in terms of the technology, et cetera. I think ESG is similar. There has been a convergence over the last decade, 5 years in particular, around reporting and so on and so forth. And so going forward, I think it's going to be a less of a feature around distinguishing how capital is allocated, because everybody's going to continue to do it, not because of the scores, but because it's good practice. And then I think related to that will be a question around how do you actually utilize the scores? How does the buy side, how do investors utilize the scoring? Clearly, with all of the different scoring outfits out there, I think what we see and hear is that there's a lot of inefficiency in the system, and that's going to need to play itself out over the next few years. There's only so many scores people can keep track of. And I think this market, kind of turmoil or whatnot over the next few years rather, I think is going to, probably clarify a little bit of kind of what's important. And the last thing I'll say is I also think that the next few years in this current environment will force us to ask ourselves what have been the unintended consequences of ESG investing. And the obvious one has been that if you look back over the last several years, current price signals in the market would suggest that we have underinvested in our fossil fuels. That, like it or not, we are going to be reliant on for some period of time. Look at what's going on at the gas pump. I think there's an argument to suggest that is a sort of an unintended consequence of ESG investing. And so I think that there's a lot of good that's come out of this. A lot of the good business practices will continue, but I also think that there's going to have to be some calibration around how we score, utilize, and apply ESG.
yeah, I agree. I think you're already seeing the convergence in the sort of ESG rating space. And that's sort of what I was talking to you about, Barbara, earlier, is I think that it's, how that convergence is going to happen. Will it be the big rating agencies that sort of, I think the good part, the vigilance with which you do your ratings, the credibility of those ratings, the fact that, when Fitch calls you up, you answer the phone quickly and you get them the information. I mean, it feels like that may be where things are going.
Yeah, and I think also if you get, it's an unregulated space. So you get the regulators in and a lot of things will change. I've always worked in the financial industry, but until I came to a rating agency, I did not know what regulation was, and it is very strict for rating agencies.
Absolutely. Dan, let me turn to you. So when this rule was first issued, I think it was 507 pages, and we were just sort of going, how are we even going to read this? But we got it, and I made some calls to the big accounting firms, and they were like, well, it's not all bad. There's things in here that are good, and there are things in here we like. But I know from your perspective, I think you're obviously looking at the rule and helping companies in the way they're thinking about it, the way they're thinking about compliance. Obviously, we provided a lot of input into SEC as to how the rule could be involved. We want to see changes in the attestation, assurance, scope 3, many aspects of this. But how are you looking at it? How are you advising your clients on how to comply with this, recognizing that it's possible, if they can read all 6,000 comments, they could issue a rule before the end of the year?
Yeah, that's a great question. I think about the word uncertainty. We don't like uncertainty in our business, right? I mean, this is something that as an organization and as stakeholders we don't like. When I did take a look at EEI's response, and it was actually really well written. So good job.
We had a lot of great support, and we received many, many comments from pretty much every company in our life.
Yeah, I imagine so. Everybody wanted to get their fingerprints on it, and that's great for you, by the way. And you know, when you look at this, is it one size fit all, or is it sector specific? Right, that's a big question. With regards to, you know, historically how much the SEC actually stretches out into getting to this level of disclosure. One of the things I think about is, you know, they're ultimately striving for transparency and standardization of definitions, which they themselves have left a bit squishy, right? And we also look at things like, okay, there are existing frameworks that a lot of this is already, you know, based on, right? TCFD, right? Task Force for Carbon Accounting Financials, you know, PCAF, right? Partnership for Carbon Accounting Disclosure, GHG protocols, you know, there's even science-based target initiatives, right? So there are existing frameworks that this is all based on some existing framework, parts and pieces that they're looking to organizations to ultimately, the registrants to actually file for. With that said, you know, as we look at comparing that to what EEI and the existing templates, which has evolved over time, right? Year over year, it's gotten better and better. You know, that's going to be a real challenge point for the SEC to really figure out. In the meantime, right, we can't necessarily control what they do. In the meantime, there are a couple of things we could do to learn from. One is, the folks across the pond are faced at a higher pace than we are, at a more accelerated pace than we are. Rebecca, you mentioned, you know, in Europe, how they're looking at this. The EU has their disclosures, the UK, France, and even in Australia and New Zealand, they're starting to do this quicker than we are, so we can learn from them. Being a global company, we get to see some of that in regards to some of the best practices there. And then ultimately, you know, there's 6 things that I talk to folks about. One is literacy. You're going to have leaders in your organization that have to get literate on this stuff in regards to the decision making around climate risk disclosure, whether they're prepared or not. They really need to start to understand this. Certain companies are, you know, check the box. They're really further advanced than others. Secondly is around governance and integration. As you set up your governance models around risk management and the integration into your existing risk management, you know, functions, you may have COSO functions, et cetera, that has to be an important thing. Third is data. How am I going to capture this data, especially scope 1, scope 2, I think that's pretty straightforward. Scope 3, you know, out of the 15 different areas, you know, what do we capture, how material is it? But that data capture is going to be really important in setting up and understanding, okay, is it going to be, you know, purchased goods and services, is it going to be leased assets? The fourth category then is, do you have the systems and processes in place? And what do you do enterprise-wide in order to do that, right? The fifth is actually a really interesting thing, and we call it opportunities and upside. By having this for all companies, primarily your C&I customers, this is an opportunity for you all to have new products and services. Provide services that they're going to benefit from, and use it as a business opportunity and upside in regards to what it can do to your business. And the last one is around preparation. How do you prepare your organization? Do you have a climate team? Do you have someone focused on this? Do you have a set of people? And setting that up. Those 6 steps, regardless of whether the decision will come, will help you get ready for the unknown.
Can I add one thing onto that? Because I think that those last couple of points are so important. I think no matter, we need to shape the rule. We as an industry need to work together to shape the rule in a way that it makes as much sense as possible. And I think there's a lot of other industries that are, they're aligned with us that we need to do that. I think regardless though, as soon as we start to report and as we measure something, it creates the opportunity to improve. And it creates the kind of obligation and incentive for a lot of senior members of companies to start to set targets to improve. For all of us in this industry, we should challenge ourselves to see that as an opportunity. Of course, within our own businesses and our own utilities, but for every other industry out there that also needs to show progress towards decarbonization, they need us to help them on that path. Electrification and using renewables to decarbonize operations, transportations, other fuel types is the best way to decarbonization. This is a huge opportunity for all of us if we just start to plan and enable ourselves to take advantage of it.
I mean, put succinctly, electricity is the answer to climate change.
It really is.
So let me, we're going to turn to the audience in a minute. We're running a little bit short on time, but I just wanted to throw one other question, because Dan, you said data, and obviously, when this rule first came out, a couple of the initial calls I got, well, one, I was on a large, I don't want to say the business group, but a very large business group, and there were questions like, what is a scope? And things like that. So we're way further down the path on understanding how to deal with this rule than many others are. But I guess the other question, and also I got calls from our public power friends who were saying, wait a minute, how's this going to affect us? And I said, well, the one basic way is that your big customers sometimes are like our big customers, and the power that we sell them, you're going to need to provide them your at least scope 1 emissions, because that will become their scope 2 emissions. So, you know, and we can just open it up on any of these scope topics, but you know, we argued on scope 3 that it was a little too inaccurate to include in an SEC filing, and it really should be voluntary. And also, we argued for and received a safe harbor, but that really needs to be rock solid because of the way the nature of the information, that you can actually have two similarly situated companies reporting very different scope 3s. So let me just open it up to the panel. Are any thoughts on providing this information to customers, the scope issues, what should be included, what is relevant, what isn't relevant? Any thoughts on that?
I would be concerned, anything that becomes an issue, is back to my point of the regulatory construct, like how do you report it and make sure you adhere to it and don't cause a problem with the regulators? Because what are the regulators going to do with all this information? Are they looking at it too?
Securities regulators or our regulators?
Your economic regulators.
Okay. Well, I would think that, I mean, right now, the experience that we've had with a template, and I think the companies have reported this too, is that the state regulators are very interested in ESG. They want to know what the company's trajectory is on the E, S, and G. But, you know, my concern is more with the securities regulators at this point.
Right, with the risk, the hazard there, yes, obviously.
But I think you do need to be consistent. That's another thing. I mean, right now, many states have their own reporting, you know, regimes, and you can't be reporting something different from the scope 3, for example, in the state than you are if it's required in your 10K. So I think that will be, you know, that is going to be a standard that somehow is going to need to be met. Any other observations? And we'll open it up. Any questions from the audience? See a lot of our ESG participants here. Any thoughts, questions? Yes.
I work for PPL Corporation IT. I'm wondering what trends you're seeing related to cybersecurity and what kinds of investments you are looking for.
All right. The question was around trends in cybersecurity, and I'm really glad you asked that question. Right before we got the 506-page NOPR from SEC, a month before we had a 280-page NOPR on governance on cyber. And I think that, you know, the challenge that we've seen, and I would like to open it up and get a response from the panel on this, but the challenge that we've seen on cyber is our industry is leading in so many ways on cyber. We have ESCC, we've got, you know, mutual assistance efforts across the industry, and then the individual efforts that the industry is doing company by company. But because of the fact that you don't, you know, sort of lay things out in your SEC filings, the real concern on that was, you know, we need to make the point about governance and oversight without giving the bad actors a roadmap. So let me just open it up. Any thoughts on that?
Look, I think about, and appreciate the question, I think about cyber, I think, is one of the more complex elements around ESG, because as you pointed out, Richard, not only is there a question around how you actually report it and articulate and convey it, but I think the equally interesting question is how does anyone score or rank or assess cyber effectiveness without being an expert in that particular area, as opposed to a more general allocator of capital or assessor of companies, whether it's an ESG outfit or otherwise. And, you know, I bring it back to, it's a little bit like safety, or, you know, customer satisfaction and so on and so forth. It's obviously important, it's good business, and companies are going to do it for that reason, are going to try to obviously be complete. But how you articulate that in an ESG score, I think, is a huge challenge.
Well, I'll say this. We were going through our response. Our cyber people, which are kind of like cloak and dagger people to begin with, they were very much, let's just say nothing. And the challenge with that is that when and they were really helpful, right? But the challenge with it is we actually sort of wanted a little bit of guidance out of SEC because when the Colonial Pipeline occurred, there were some really heavy enforcement actions that followed that. And some of it was because, people up and down the supply chain from Colonial weren't being talked to, and so you can't report what you don't know, even though it's impacting your operations. Unfortunately for us, it didn't. But we felt that some guidance was good, but too much information is not good.
Yeah. I totally agree, and clearly cybersecurity is critically important to our industry. I think, Richard, you had a great set of comments at the outset of the response to the question. Our industry does work really well together, lots of collaboration with government agencies, lots of collaboration among each other, and I think we've done a good job. I think there's always more to do, but there's also a lot of regulatory requirements with respect to cybersecurity, which is very different than a lot of other industries in our sector. So I think it's critically important. I think there's a lot of sensitivity to talking about it publicly because no one wants a target on their back.
Great. Any other questions? All right, seeing none, thank you all very much.
I think we had a question back there.
Sorry. You have a microphone.
The Texas state legislature just passed a bill last month, I think, that's aimed at blocking ESG in the financial industry. And lots of other states are looking at it, and maybe even some U.S. congressmen. I'm wondering what you think the implications of that are for the energy industry and whether you're concerned about, at least about the turbulence that it introduces into the business environment.
Well, I'd like to, or do any of the panelists have any? I didn't look at that particular legislation, but I am aware that there are bills at the state level where they think maybe industries at the state level might be disadvantaged because of ESG. To John's point about investing and underinvesting. Any reactions to that?
I guess if they're and I've seen the West Virginia one too, if they're blocking the blocking, that's a good thing because that gives more access to capital.
I guess too, I'll just add, I think our perspective on ESG is that, it's the reality of it varies company by company and aspect, ESG aspect by aspect. And so it's very hard to say everything's material, everything's not material. But generally speaking, we've embraced ESG because it's a way to provide a strategic view, where the company's going, a look ahead, give a sense of the company's values and where it's going. That's sort of the real value of it. It's not, it's not necessarily, I think there's some people out there that look at ESG as a way to kind of route capital this way and that way. And that's what people like Barbara and John do.
Right, and I would kind of characterize it this way, maybe to try to summarize, is that the positive that I think ESG has provided has been effectively to provide a platform through which companies in the sector throughout corporate America can benchmark and effectively set goals and improve in the areas where it makes sense to do so. But again, all in the context of largely good business practices. Where I think there have been some unintended consequences, and I think this is what some of these state legislatures are trying to address, is that to the degree it has resulted in inefficient flows of capital, right? In other words, capital being constrained from certain industries that we as a society rely upon. That's then, history says the markets find a way to correct those issues over time, and ESG will have to just sort of be factored into, how that plays itself out.
I'll just tag on to that, and I think John had this comment in response to our recently announced goal around Real Zero, is we're going to stay focused on doing what's right for our customers, what's right for our business. And fortunately, I think these are all really well aligned. So making investments in clean energy, lowering bills for customers, ensuring that you bring down the volatility in fuel costs, you ensure long-term resiliency in our businesses. That's the right thing to do. And we're going to continue staying focused on that, not a check-the-box exercise, but focus on good things for customers, good things for the business, and ultimately that's the right thing for long-term investment, credit, and also doing good business.
And we'll have a new acronym, MGBS, makes good business sense.
There we go.
There we go.
I was going to say, I actually saw one of the companies, I don't know if this is only just this company, had ESG plus F. And we're like, plus F, what's the plus F?
Yeah, that's what
Financial.
Avangrid did.
Yeah, that's
was
what
the
it was.
Finance.
Financial.
Yeah.
Financial.
Yep.
I think we're an ESG plus, so great presentation.
Thank you, guys.
Thank you.